Top crypto investment mistakes you need to avoid. Investing is not easy at all. In fact, many people actually end up losing assets due to bad investments and basic mistakes. But it's hard to argue the fact that smart investing can see some extremely healthy returns and is easily the best way of making your money work for you. The world of cryptocurrency has opened the doors to all kinds of informal retail investors, as opposed to traditional stock exchanges with an extremely high barrier of entry and a number of fees and commissions. Crypto investing is a very simple and direct process. Furthermore, the sheer volatility of the crypto scene means the potential gains and losses are so much more vivid. A 10% growth overnight in crypto is commonplace but could potentially shut down legacy financial markets. The last year has shown the general public that crypto offers investors a lot of benefits. However, fresh-faced crypto investors are making a lot of rudimentary investment mistakes that are costing them a lot of money. You've joined us at the perfect time. Welcome to No Cap Crypto, as we take a close look and outline the most common mistakes that new crypto investors are making across the decentralized landscape. Make sure you pay close attention and stick around. One of these common mistakes could be costing you a lot of money. Number 1. Always buy the dip. One of the biggest and most obvious issues with new crypto investors is following the trend. Maybe a friend of yours told you. Maybe you read a news article. Maybe an influencer mentioned it. A crypto project is absolutely exploding. You rush in and see the price spiked and rising and buy in without a second thought. Next thing you know, the price dips and continues to drop. Your initial investment is worth a fraction of what you put in, and the coin may never recover. Never buy high and never sell low. If an offering is on the rise, make sure you get in very early because there's a chance that you missed out. But don't worry, because in crypto, the opportunities to make money like that are extremely common. Don't let that fear of missing out, or FOMO as it's called, sway your financial decision-making process. And if you did buy in too late and the price is about to tank, well, here comes the difficult decision. Do you try to minimize your losses and sell immediately, or do you hold your assets in the hopes that the trading price will ultimately recover and net you a profit? No one knows the answer to that, unfortunately. However, you can mitigate your levels of risk through some intelligent financial assessments. Perhaps the most common and most effective is the process of dollar cost average. This classic investment strategy is traditionally used as a means of minimizing the volatility of an asset, dividing the total amount you plan on investing into a project and buying in over time. This would result in you averaging your buying price. Not a single lump sum crypto investment, but rather many small investments would give you an average buying price, most reasonable and predictable. Although buying high and selling low is a classic new investor mistake, buying just because the price is too low is also a serious error. Number 2. Buying because it's cheap. It's great to have that bullish and aggressive investment mentality, but sometimes you need to take a step back and realistically assess a financial opportunity. Looking at a project that you consider seriously undervalued and buying in might sound like flawless decision making, but there are a few core concepts that many new crypto investors seem to forget. Market cap or market capitalization is a very common concept across all financial markets. In the legacy trade, it's an indication of a company's overall valuation and potential size. A very basic and simple measure, a larger market cap would indicate a larger institution or project and can be calculated by considering the overall unit price and total supply. While market cap considers both unit price and total supply, as a trader, you'll initially be considering the individual unit price when facing an investment decision. A project might be undervalued according to its unit price, but that may be due to the fact that an insanely high supply of coins would drive down the value of each individual unit. Looking at something like market cap when considering crypto projects would help you get a better understanding of the potential reach of a coin and the actual size of the project and paint a clearer picture. Relative to other projects, a mid-size or small-size market cap project still has room to grow, whereas a large cap project shouldn't be seeing any real token valuation increases. These small and mid-sized projects are the major attraction of crypto investments due to their insanely high level of volatility. While it's true that they do have a higher chance of seeing insane price swings, they do come with their own set of problems. Number 3. Be careful when looking for 100x gems. This is easily the riskiest aspect of crypto investing, and although many crypto investors do actively hunt for these gems or moonshots, as a new investor, you need to be a lot more careful. In fact, many beginners often lose money with this strategy. Investing in 100x gems will require you to have diamond hands. This is common phrasing across crypto and indicates the certainty of your investments and decision making. Many fresh-faced investors have paper hands, selling immediately and buying into shady projects. Other major issues with these small cap projects is that a lot of them lack history and information. Faceless teams are created by individuals from around the planet. A lot of these small cap projects are borderline scams, with teams just dumping tokens for a fast buck and just abandoning projects. There's no legal obligation from them and no regulation to stop them. 100x gem investing is also very fast-paced, and these heavy price swings occur over a matter of hours. This requires investors to put a lot of time into actively managing their portfolios. While the big currencies do insane levels of volatility, this happens over a manageable period of time. 100x gem might reach insane levels in an hour and then crash to nothing the next, never recovering and ultimately losing your entire investment. Number 4. Leveraged investments. Even traditional financiers tend to avoid using leveraged investment strategies, and it's highly recommended exclusively for extremely advanced investors if recommended at all. Seriously, using leverage as a core or even a small part of your investment strategy is generally a bad idea. Leveraging relies on the usage of borrowed finances in order to invest. You're basically investing with money that isn't yours. This is, of course, money that you have to pay back, but as you can imagine, is very attractive for many investors. It's important to invest with certainty and confidence, but is generally advised against investing money that isn't yours. Advanced investors operate with a higher level of intelligence and a more mature and complex decision-making process, but the level of risk you take on is often not worth it. It can be clear to see that the general trend of advice that new crypto investors need to look towards is minimizing their overall levels of risk. This brings us to our next point, but first, we need to ask, hey, are you liking the video so far? If so, I have good news. Make sure you like and subscribe to No Cap Crypto because we release videos like this every week. Also, comment below and let us know of any crypto investing tips and tricks you may have. And make sure to stay to the end because you would not expect the kinds of mistakes that even veteran investors are making. Number 5. Diversification. As a new crypto investor, you've definitely heard of the big names across the sector. Bitcoin, Ethereum, etc. But the problem with entering any kind of financial market is throwing all your financial capital into a single asset. Any investor from both the decentralized and centralized landscape will tell you that that is a seriously flawed investment strategy. As a crypto investor, the last thing you want is your overall portfolio success to be hinged so heavily on a singular asset. Unfortunately, many new investors enter the marketplace and just invest all their finances into one of two coins, and unless you're 100% right, you'll end up at a loss. Diversifying your portfolio involves dividing your total holdings over a variety of different holdings. Although you may be certain of some investments over others, you're ultimately looking to hedge your investments. Hedging is the process of holding less riskier assets as a means of mitigating the potential losses of your primary investments. This doesn't mean that there's no chance of losing value, but rather that your losses won't be as bad due to your multiple holdings spread out across the marketplace. Number 6. Invest what you can afford. Crypto does have the ability to make you some serious cash, and there do exist more and more people that are turning to crypto investing as a full-time means of income. But it's hard to ignore the fact that the sector is filled with insane levels of risk, unlike any other investment opportunity on the planet. Don't jump into the deep end and throw in all your savings. The mark of a great investor is the ability to lose and gain assets whilst remaining calm and collected. Never let emotions sway your decision-making process, and make sure you're ready to lose all your investments. Investing more than you can afford has left many new crypto investors fearful and scared when watching their investments rise and dip, playing with their emotions and putting heavy levels of stress on them. Crypto trading is a very difficult and very challenging world that's filled with innovative new concepts and exciting new ideas. Be intelligent and be wary. Let us know what you think about the major mistakes that crypto investors are making and whether we missed any in the comments below. Keep in mind, I'm not a financial advisor and that this video exists purely for educational purposes. Please do your own research and make your own intelligent financial decisions. Don't forget to subscribe to the channel so you don't miss out on our next video, and I'll see you in the next one.